Hello and welcome to KYC. I am Sharad Dubey and with me is Anushi Vakharia. And today, Anushi, the company is a Raymond Group company, but it is a demerged version of it. The realty business is coming in. And largely, there is no major coverage from the analyst community as well. And a lot of our viewers actually wrote to us and they stated that let's figure out what is this company all about. But there are a lot of questions about this company. But after its listing, Anushi, it hasn't been a great returns for the shareholders, of course, who are holding in the Raymond in that demerged basis. But let's put out the questions, what we want to actually know about the company. The first question is, which categories is the actually company focusing on? Is it the mass affluent or is it the recently announced luxury segment? They have a massive project in Thane, that's something which we'll be looking out for. And will this expansion involve non-MMR markets as well? MMR is the Mumbai Metropolitan Region markets, to simplify for our viewers, and how the demand queries are actually coming up for these new projects. Interestingly, Anushi, the third quarter is a very heavy quarter for realty space as well.
A lot of launches.
Yes, exactly. Launches, pre-sales, which you track. Land monetization plans ahead, that's something which you'll be looking out for. Will they go for JD, JV on an asset-light basis? And the timeline for the promoter press release, that is an overhang in this stock as well. And cash flows also, so we saw in H1 numbers that got impacted, maybe because of upfront higher costs in the realty space. So these are the key questions for this company. Very less tracking of the company. That's why I think we should give a 360-degree view to our viewers for KYC. So Anushi, what is it about the company totally?
On that note, let's start off with what's happening with the company. So if we just talk a little bit about it, it's mainly its presence is in the MMR region, and it's a real estate development company of the Raymond Group. You know, Sharad just spoke about the recent demerger which took place. That was Raymond Lifestyles as well as Raymond Realty now. So it was demerged from the Raymond Group on 14th of May onwards, and then it subsequently got listed from July onwards. So since then, we'll be tracking its performance and how the financials of FY25 have also shaped up. But just a little bit about the kind of portfolio that the company has. Now, it has about 100 acres of land parcel in Thane. If you take the whole long-term portfolio consideration of the gross development potential size that we are looking at, 40,000 crore is what we are seeing. Thane land parcel of 100 acres. Along with that, they've signed joint development agreements as well. So this adds up to about 25,000 crore. JDA opportunities adds up to about 14,000 crore. So cumulative 40,000 crore is the kind of mix that we are looking at. Now, do note that currently of this 100 acres land which is there, 55 acres of Thane land is currently under development, of which if you look at the realization part of it, revenue potential is around 13,200 crore, of which so far 8,200 crore have already been sold. While if you look at the remainder, from that, they have collected 6,300 crores so far as well. So, you know, FY26, the second half, the FY27 picture is an interesting scenario, considering that they have this huge land parcel which is already in place. With the JDAs, they have a development potential of around 14,000 crore. We'll see a couple of launches coming these next 3 to 4 months, in the 6 to 9 months period itself. And these are 3 to 4 launches that we are seeing across Bandra and other key regions in Mumbai as well. Balance will be launched in the next 12 to 18 months is what we are looking at. So if we just take a mix of what's happening, your Bandra, Mahim, Sion and Wadala are some of the key areas where these JDAs are coming in picture. And if you are looking at that, all of these are located in MMR region. They do not have a presence apart from these particular markets that we are seeing. In terms of the mix also, while it is in premium and luxury, I want to just point out how the own land bank is shaping up and how the JDA is, since you know JDA is a rather asset-light model that we are looking at that. So current FY25 and 28, if we just pull up that one, from a 78% mix, now it is estimated that that would be 50% or also in FY28, while JDA contribution from 22% will move upwards to 50%. Now, this is the management's aim to bring this ratio to 50-50. So this is an interesting part that we are looking for the company. And with these key launches planned in the second half, how pre-sales and thereof the cash flow shape up is something that we should be watching out for, right?
Yes, Anushi, the expectations is a very important portion, she pointed out. But Anushi, the entire KYC segment, there are 8 parameters where we judge the company. But remember, it's not fair at times because the company's history itself is on a very short notice, and there is a literally zero analyst coverage in this segment. But nevertheless, our format of the show is first we take in the income statement, operational parameters, especially for a real estate company. We are also taking in the balance sheet and the cash flow. These are the four most important parameters in the financial segment. Apart from this, the shareholding pattern, how it's actually panning out post the demerger, and the street cred, how the stock has reacted. It's a very short term basis, but nevertheless we will take them in. Valuations is also there, and overall outlook, that is very much important, that we'll be judging the company on. So 8 parameters where the momentum would be coming in for. But Anushi, starting with income statement, what are you gathering from here? I think H1 numbers is something which you'll be looking at now.
Absolutely. So, before I talk about the income statement, I want to point out to the key operational metrics because, with real estate companies, we have pointed out that there's lumpiness in terms of how the revenue shapes up, how that is recognized. So, if you just look at the pre-sales number, now by the end of FY25, we are looking at a pre-sales of 2,300 crores, showing about a 3% of a growth. This is in comparison with a 67% or a 40% of growth figures that we've seen. So how H2 will shape up is something that we should be watching out for, because even in the first half, there was a dip of around 35%. So pre-sales for these last 2 periods have been on the muted side, but the management is quite optimistic on achieving that 20% of pre-sales guidance. So that is on a positive that we are seeing. Collections also, while they've maintained a 21 to 22% of a growth in these last 2 fiscals, this time the collections were also down about 18%, but they expect recovery also in this particular metric. So considering all of these parameters and a huge launch pipeline that they anticipate in the second half, we've given this a neutral rating. Do note that the 4-year pre-sales CAGR, that stacks up to about 55%, and 4-year collections CAGR is 64%. So the history has been rather on the positive side. It's now the expectation and execution which will be a key monitorable to watch out for, right?
Thank you very much, Anushi, for that. And it's a very important thing you stated is first, let's just put in the operational parameters. Then I think I'll just discuss the income statement and revise it once again. So already a neutral rating coming in from Anushi when it comes to the operational parameters. And that's the first thing to look at, not the income statement. Now let's look at the income statement. The revenue growth over here, that's of course 1,000 crore plus in H1. And EBITDA numbers are also there, but largely we do not judge a company in terms of these numbers in the real estate space. Net profit for all companies, it matters. It's decent, it's around 77 odd crore rupees, but the company needs to have a long history for us to judge as well. But net, it is decent, and margins 22.9% ahead of this demerger. Now you see that's actually coming down, so that might be a cause of concern. But nevertheless, let's give it more time to the company as well. So it will be a neutral rating coming in from my side.
So on the margin part, there is expectation that this would scale back upwards to 20%. So that would be something that, the street should be watching out for, whether this 20% number will be there in the next FY27 figure that we are looking at. But moving on to balance sheet now, if you just look at equity and other equity, of course, there would be divergence in terms of how these 2 numbers shape up, considering that there was demerger, so there would be new shares issued. So taking FY25 and H1 in comparison on a like-to-like basis would be unfair, but we'll just point out how the H1 has shaped up. Other equity stood at about 1,200 crores, almost up to 1,300 crores, while borrowings are 564 crores and cash in bank at 214 crores. So this, considering the first half, remains on the healthier side. So it's the future periods that we should be watching out for. Hence, considering the first half performance, considering the debt to equity level, which is on the lower side that we are looking at, we've given this a thumbs up.
Okay, a thumbs up coming in for the balance sheet. Cash flow, very important trigger for a real estate company. But of course, we see the history is less, but it's on the lower side. Operating cash flows in H1 was down almost 300 odd crore rupees. Even the net cash flows is there just a mere 53 odd crore rupees. And we have seen that these cash flows, there's of course a lumpiness involved in that as well. Maybe initially the JV expenses which the company might be undertaking, that's why the hit is coming more on the cash flow. So because of that, based on the current numbers, I will give a thumbs down for the cash flow segment.
Okay, so that's on cash flows is what we are seeing. But moving on to shareholding pattern now, we'll have two periods of data as of now. Promoter holding remaining constant at 48.9%, while FIIs have offloaded some bit of that share that they had from June levels. We're looking at about 11% stake as of the second quarter end, while DIIs have about 4.5% of stake, and public holds 35% of overall value to the company, which is there. Hence, considering that there's limited data as of now, we'll be tracking for upcoming quarters as well on how the FII and DII mix shapes up. We've given this a neutral rating.
All right, neutral rating coming in for the shareholding. But overall, let's look at the street cred. Post its listing after the demerger, there hasn't been much returns coming in for the investors. Last 1 month stock is down 19%. But the cause of concern for me, since listing is down almost 46 odd percent, and that downtick is something to be actually concerned about. Whether is this a wrong pricing which came in during its listing, or there's a lack of analyst coverage. A lot of questions do come in, but as and when company comes out with its own investor presentation, the management is going to talk with us in some time, then we'll get more clarity in as why there is so less coverage in this counter as well. But it has been on a free fall, so that's a cause of concern for me. So I will be giving a thumbs down for this category.
Okay, coming to the valuations now, what we've done is, while price to earnings, we've derived at a multiple of around 44 times, and this is based on the 12-month trailing EPS, which is there. It seems like a metric that we should be constantly watching out for. It seems on the higher side though. So how this shapes up, considering that there's lumpiness in terms of where the income statement numbers are, we've given this a neutral rating as of now. So that's on the valuation part that we are looking at. So, but coming to the outlook forward, which is there, now here is the interesting story. Firstly is the 20% of pre-sales growth expectation, which is there. Along with that, now the mix in terms of joint development agreements, that is expected to be 50% in this next 2 to 3 years. Now this is an asset light model that we are looking at. So how the financials will improve with this higher mix is something that should also what we should be seeing. If we just talk about the planned launches which are there, now the company expects about 2 new launches on its own land, which is the Thane land parcel that we've talked about. Along with that, there's 3 to 4 new JDA projects which are coming. So if you just take a cumulative figure for the second half itself, it's a 5,000 crore of gross development value that we are looking at. And this is with the expectation that going forward margins will stabilize at 20% or so, which is a high uptick that we have seen from the FY25 and first half levels, going back to its previous trajectory which was there earlier. But along with that, they're also seeing that the cash flows, which we talked about earlier, that being positive as well from the second half. So that's the overall outlook that we have for the company. It's a neutral that we've given, right?
Sure. And let's just revise the overall standings, how the KYC ratings stand. And largely it has been neutral on the income statement and the operational metrics, which Anushi pointed out. Balance sheet was decent, but cash flows is a cause of concern is coming in. And let's pull out the shareholding and the valuation neutral here. Street cred, we have given negative because there's a massive wealth erosion post its listing, and that's a cause of concern. We'll be dealing with the management. Outlook, it's neutral to positive overall. But net, it's 4 out of 8 is generally historically we give that's an average number coming in for the company. But of course, there was a big conversation you had, Anushi, and that was with Harmohan H Sahni. He's the MD and CEO of Raymond Realty. Please listen in.
Let me start off by understanding this new product launch or new project launch that we are looking at. If you can give us more details of this.
Sure. So this is a project which we are launching, which is in the luxury segment. The name of the project is Invictus by GS, and the location is BKC Bandra. This project has a total revenue potential of 2,000 crores, and it will be executed over the next 4.5 years. We are launching it today. The work at site has already begun. Then we are geared up for welcoming customers over there. We've already seen a very good initial response. This is going to be premium 3-bedroom, 4-bedroom, and even higher configuration, which will be available for sale. And good inventory with the excellent location. And this is what we have currently launched, and going forward we would be launching more projects also. Since you mentioned our pipeline. So outside of Thana, we are launching another project in Wadala soon, end of December, beginning of January. That launch will happen. That's also a large project with revenue potential of about 5,000 crores of top line. And after that, in Q4, towards the end of Q4, we have another project which is in Sion that will be launching. That is with a revenue potential of about 1,700 to 1,800 crores. That's a project called Address by GS. Wadala will also be an Address by GS product. Apart from that, in Q4, we are also launching projects in Thana itself. So in Thana, we have already in H1 launched one Invictus by GS, one Address by GS. And in Q4, we will be launching a 10x product, which is a two-bedroom community that has a revenue potential of over 1,000 crores. And then we are also launching a retail-focused high street inventory in Thana, which is Park Avenue. That there also the revenue potential is approximately about 1,000 crores. So in all, between now and end of the year, we'll be launching 3 projects outside of Thana and 2 more in Thana.
So, Mr. Sahni, just want to understand, while the overall potential that you've given is around 40,000 crore, and I'm assuming this is a 5-year perspective that we have for FY26 and 27, what's the kind of overall gross development value that we are seeing, and how is execution going to shape up is also another question that I want to understand, considering that you're also targeting for an annual run rate of around 4,000 crore of revenue. So, help us with that as well.
So what you're referring to is the pre-sales number.
Right.
So if you see last year we did pre-sales of approximately 2,300 to 2,400 crores. It's 2,300 some odd number. And what we've given a guidance that we will be giving a 20% growth over that, which takes the current year close to 3,000 crores. And we are on target to achieve that number with all the launches that we have planned. And this is how the entire year's planning was done by us. So in H1 we did pre-sales of about 760 crores, and it is going to be heavy in H2 for us. But that's how it was planned. And going forward also, FY27, if I see, there also we are looking at a 20% growth because with all these projects which we would have launched by end of this year, that growth would be more or less locked in because we will have enough inventory available in Thana and outside of Thana to give us that kind of a growth number. And the 4,000 crore number that you mentioned that we will achieve, it will be towards the end of 28 or beginning of the year after that, we would have hit that number if you take this 20% growth run rate that I mentioned.
So just want to understand on that aspect, while you're maintaining a 20% of a booking growth, that's the pre-sales growth that we're looking at, the first half, we are looking at a decline of over 35% or so. Is it on the basis that most of your launches are skewed towards the second half that we are seeing, or were there any other concerns like how other real estate players have also pointed out with regards to regulatory overhangs being there, or there would or pricing now playing into a factor which has led to that softer acceleration? Because across industry, if we see, there has been a slowdown in terms of whether volumes have been concerned. So just want to get the overall industry perspective as well, and how you are positioned for the second half, and even if you can give us a picture for FY27 as well.
So, for us, the situation was quite unique because we didn't have enough inventory to sell. So we did not see any hiccup or delay as far as the demand front is concerned. In Thana, we had such a bumper Q4 of last year that we didn't have enough inventory available for this year to show a big H1. But having said that, it was also planned in that manner because all our launches, when we see outside of Thana, because of the way they were lined up and how we had signed those projects, they were scheduled to launch only in H2. So, I mean, we have not experienced any regulatory overhang or any pricing pressure in any of our projects also. We've underwritten these projects at very fair assumptions, keeping in mind what the market is in terms of its cycle. So unless, we are compelled to sell at a very high price and then you see pricing pressure, I don't think we are in a situation like that. Can't say much about generally what the other players are experiencing. But as far as the market is concerned, I mean, I have not seen any evidence of pressure either on pricing or on volumes. When you talk about the growth number for us, for H1 as compared to last year, in our industry, you can't really compare quarter on quarter because a lot is dependent on when the launches are happening for each project because you see a significant bump up in sales when the launch takes place.
Understood. So it's a 20% plus of growth that we can expect for FY26. And from what I'm hearing from the commentary as well, there's a lot of emphasis on Thane market, right? So just want to understand what's the kind of pricing growth that you're seeing there? What is making you so excited about this particular region? Are there any other regions like Thane as well that you're going to be focusing on with new launches there as well? If you can give us more perspective on that as well.
Yeah, so Thana has been our home ground because we started our business in Thana, that's legacy land. So naturally, it's a 100-acre plus parcel. So there you will see a slew of launches over there from us. It's a very, very strong market. Still one of the best markets in Bombay in terms of the social infrastructure and the affordability factor for as far as pricing is concerned. It has a very cosmopolitan crowd, so it attracts all kinds of people, not only one segment. So it's a very strong, very deep market. So naturally, we want to stay focused on that as one part. The other part that we are focusing on is in and around BKC. We have taken a very, very strong position in the market. So all our projects, if you see the various new projects that we have signed, are all creating a ring around BKC. So the one we are launching today, Invictus by GS, is right next to BKC. Then the Wadala one, which we are launching, that's another big launch this year. That is also within 10 minutes of driving distance from BKC. The Sion is literally walking distance from BKC. You just have to cross the railway line and you're there. And now with the connector from the Eastern Express Highway straight landing into BKC, it's a very, very prime location. And the other projects that we have signed, which we will launch next year, also are right next to BKC. So these are the two primary areas that we have focused on, looking at the segment that we want to serve, which is the premium segment to luxury segment.
The management is very upbeat about BKC and Thane regions, and an important disclosure is also coming in from the company. Hardly tracked counter, tested the patience also of the investors. But let's just pick up the key management takeaways, Anushi, from this discussion and which you had done. They are going to launch 3 or more projects outside of Thane by year-end itself. That's pretty interesting on that. But the numbers front, I think we should tell our audience what they're actually planning, a 20% odd growth.
Yeah, so 20% is the kind of pre-sales growth that they're expecting, and this is with margins also inching upwards to 20% or also that we are seeing. Apart from that, we're also looking at an important piece is that now there's no regulatory overhang, which has been a theme for the South-based players that we are seeing. Along with that, even pricing pressure is something that has not been a concern for the business, right?
Yes, that's a qualitative statement coming from the management, and net, we would say that there is a positive commentary coming in, but we need to give the company more time so that more data comes in and then we can give them proper ratings. As of now, it's 4 out of 8 in KYC. That's all for the show today. Stay tuned to NDTV Profit.